Astra Labs dropped 11.5%, and everyone is panicking. The lab's proprietary score sits at 61 out of 100, well above the sector median. That rating reflects robust hardware demand and tight silicon supply bottlenecks, fueling revenue growth. But the lab score is 61 out of 100. Why? Here's why the sell-off is wrong. Astra Labs is flashing red on every trading desk, plunging 11.5% to $382.89 as a massive $60.5 million insider sale by Chairman Manuel Alba triggers panic. While Wall Street obsesses over this executive exit, the real story is the post-earnings hangover from their March quarter, where a solid 11.6% earnings per share beat of 61 cents on $310 million in revenue failed to sustain the hype. Capital is actively rotating out of high-flying connectivity plays as investors realize that even consecutive earnings beats cannot shield the stock from valuation gravity when leadership cashes out. The market's panic ignores the physical bottleneck. PCIe 5.0 retimers remain supply-constrained. Each NVIDIA Blackwell rack requires massive interconnect bandwidth, pushing Aries smart cables to their thermal limits. While Broadcom leverages its co-packaged optics to bypass retimers entirely by 2028, Astra's qualification lock on PCIe 5.0 secures near-term margins. The engineering reality confirms the long-term bull case. Hardware bottlenecks make these chips indispensable, regardless of executive sales.
Quarterly financials showing modest revenue momentum for Astra Lab.
By Q4 2026, restrictive monetary policy will compress Astra Labs' valuation multiple by 20% as rising capital costs slow down data center deployments. While Astra delivered 93.4% year-over-year revenue growth in its latest filings, the macroeconomic waves are shifting from acceleration to friction. The Federal Reserve's restrictive 3.63% policy rate and a normalizing yield spread of plus 0.35% are driving up the cost of capital. With prediction markets pricing recession risk at 8.2%, large-scale cloud providers are tightening budgets. On the policy front, trade war protectionism and potential Greenland-related tariffs threaten global hardware supply chains, creating an immediate headwind for capital-intensive AI infrastructure. Geopolitically, strict U.S. export controls on advanced AI processors directly cap Astra's addressable market, as their connectivity chips must physically pair with restricted silicon. This regulatory chokehold is compounded by rising Taiwan-centric supply chain risks, where any disruption to TSMC immediately halts Astra's fabless production. Socially, growing political backlash against big tech's energy consumption is forcing a pivot toward power-efficient hardware. While Wall Street focus remains on the $60.5 million insider sale, the real threat is this dual squeeze of policy whiplash and high interest rates. These macro realities will inevitably force a repricing of Astra's premium valuation. Astra Labs reported earnings per share of $0.61, beating the Wall Street estimate of $0.55 by 11.6%, a solid beat that signals strong execution. Astra Labs Interconnect is trading below its 20-day average at 3. Astra Labs management's headline: "We delivered another quarter of strong execution and innovation." That's the phrase they want you to remember: execution, innovation, strength. It's designed to make you feel stability, momentum, and a company firing on all cylinders. What it's designed to make you not think about: the $60.5 million insider sale by Chairman Manuel Alba, or the 1.97 million shares net sold by insiders in the last 90 days. That's not diversification, that's a coordinated exit. When founders and chairmen sell that much stock in a single block, it's not about cash flow needs, it's about conviction. And conviction is what's missing here. The EPS beat, 11.6% above estimates, looks like strength, but the trend tells a different story. For straight quarters of beats, averaging nearly 20% surprises, yet R&D as a percentage of revenue is expanding, 35.7%, up 51% year-over-year. That's not efficiency, that's desperation to outrun commoditization. Wall Street is cheering. Stifel just raised their price target to $460, but ARK trimmed its position, and BlackRock cut 12% of its stake. The sell side is raising targets, but the smart money is quietly stepping back. Short volume? In line with baseline, but that's not the point. The point is that management's language is shifting from record demand to execution, and that's not a synonym. They talked about unprecedented growth. Strong execution. That's code for we're not guiding higher, but we can't say that out loud. What management is saying is confidence. What the lab hears is caution. The momentum breakdown for ALAB. RSI sits at 49, pointing to neutral zone, waiting for a clear directional signal. MACD is currently bearish, with downward histogram pressure. The bull case for ALAB rests on physical hardware bottlenecks. First, the massive rollout of NVIDIA's Blackwell architecture demands high-speed smart cables to prevent processor data traffic jams. Second, passive index inflows from their upcoming NASDAQ 100 inclusion will force massive mechanical buying. But here's what breaks the bull thesis. Astra's trailing price-to-earnings ratio of 260.5 times leaves zero room for execution errors. If major cloud providers delay data center build-outs, their single product concentration exposes them to immediate downside. The critical question is, how long can Astra maintain its qualification lock before PCIe 6.0 triggers a requalification cycle? Our answer: the late 2026 transition opens the door for Marvell and Broadcom to aggressively bid for sockets, eroding Astra's near-term pricing power. Intellectually honest tracking. Our previous buy calls in late June above $450 were premature, failing to anticipate this sharp insider-led correction. If Astra holds support at $330.86, expect a post-earnings recovery toward resistance at $483. If it breaks below, the stock will slide to its 200-day moving average of $284. Given our AI score of 61, we expect near-term consolidation. Here's the macro picture shaping ALAB. Strict U.S. export controls on advanced AI chips to China directly limit ALAB because their connectivity hardware must be physically paired with restricted NVIDIA or AMD processors. Meanwhile, high interest rates make the massive capital required to build next-generation data centers more expensive, which slows down how quickly cloud providers buy Astra's products. The explosion of artificial intelligence is driving demand for Astra's smart chips, which act like high-speed multi-lane highways to prevent data traffic jams between processors and memory. While competitors like Broadcom and Marvell offer broader product lines, Astra's specialized focus on these specific connections gives them a temporary performance advantage. Over the next 6 months, the massive rollout of NVIDIA's new Blackwell chip architecture represents the biggest growth trigger, as each new system requires more of Astra's specialized connectors. Conversely, the greatest threat is that major customers like Amazon or Microsoft might delay their data center expansions or design their own competing chips. ALAB triggered a strong buy signal on massive AI connectivity demand. Are you holding ALAB? Drop your entry price in the comments. As a quick reminder, this channel's content is strictly for educational purposes only and does not constitute professional financial advice. Please make sure that you always do your own thorough research before making any of your own investment decisions, as past performance is never a guarantee of future market results. If you want our full breakdown on Credo, the link is in the description. Subscribe so you don't miss Tuesday's deep dive. We're tearing down ARM. Thanks for watching the Denver Stock Lab.